Okay, welcome to the CLO Market Overview panel. My name is Rebecca O'Brien. I'm a partner at Clifford Chance. I represent asset managers for CLOs and other structured products. I'll just let the panelists introduce themselves. Alina, would you like to go first?
Sure, I'm Alina Pak. I'm part of the Fitch Structured Credits team.
I'm Greg Kovac. I'm on the trading team at Raymond James CLOs.
My name is Konstantin Kulev. I run the CLO team at MUG on the sell side.
I'm Kulma Chazad. I work for PineBridge Investments as part of a junior portfolio manager for their CLO tranche investing strategy.
And good afternoon, everyone. I'm Shuman Bose. I am one of the senior bankers on the CLO side with Morgan Stanley.
Great. So we're going to start with a polling question, if we could get that up. So the question is, how many deals should a manager have issued before you'd approve them? Obviously, coming at it from an investor angle, but feel free to kind of give your views. And we're going to come back to this a little later on when we touch on some investor and manager issues. But to start, we're going to start with a general state of the CLO market. So Konstantin, could you kick us off with your thoughts on the current state of the market, current issuance levels and drivers, and where the arb is?
Sure, happy to do that. Thank you, everyone, for your time. So the main theme over the last 2 years, the way we see it, has been the challenging arbitrage conditions in the CLO market. So after record 2021 year of issuance of new issue refinancings and reset, we have seen about 88 million or so this year between BSL and middle market CLOs from 100 managers versus 110 million from 96 managers in 2022. How do we know that the arbitrage is challenging? Obviously, it's CLOs are an arbitrage vehicle, so we always hear from, especially from the equity investors, it's not easy to create a profitable transaction, but here's some signs that we know that that's the case. So first of all, in 2022, a lot of the US bank investors significantly reduced their investment levels, which has resulted in elevated AAA spreads throughout the last couple of years. In addition, we see the traditional third-party equity investors who were very active in 2021 and before, effectively significantly reducing their investment levels. Over the last couple of years, according to various estimates, about 70 to 80% of the equity investments are basically sourced back to captive funds that the managers have raised, as opposed to the third-party equity investors that I was referring to. Even the third sign is even managers with captive equity have been noticeably absent from the market. Obviously, it does vary by name, but certainly a number of active managers have had significantly reduced issuance over the last couple of years. Having said that, the loan market price volatility has created a number of short window opportunities at various points in time this year and last year to create at least, let's call it times zero profitable transaction for the equity as projected with some base case assumptions. AAA spreads have shown remarkable resiliency to tightening throughout 2023. Very briefly, a quick overview of how that went. So we started the year in the 190 to 235 range, tightened to 170 to 175 to 220 in late January, February. Then it was a bit softer for some time, 185 to 225, and then we only saw a 175 print in May. Since then, after that, for a few months, it was a very slow grind to mid-high 160s. And now we've seen the last couple of weeks, we're probably about 10 wider. In the meantime, to compare on the asset side, the LSTA loan index went through multiple ups and downs of multiple points each. So, and the range was from 92.5 to 96 points, currently sitting at 95. And this was basically multiple ups and downs where the variations were quite significant, again, compared to the type of small movements we have seen on the AAA spreads. AAA spreads between managers has loosely been between 30 and 50 bips for most of the year. Loan spreads in new issue portfolios have been relatively constant given the high proportion of secondary loans that go into these pools. The new issuance which is theoretically has been at elevated spreads throughout the year, represents a relatively small portion of CLO portfolios. So very quickly, I'm going to wrap up because it's a broad question. I'll give my fellow panelists a chance to chime in, but just want to talk about the impact on CLO managers that this lack of arbitrage is having. So we see at least 40 managers who issued a new issue CLO in 2021 and 2022 not issuing a single deal in 2023. This is more than 30% of the universe of managers of 125. This, again, obviously, there are questions what exactly represents the manager universe, but for us, we're taking anyone who issued a deal in 2021 and 2022. 125 managers, 30% at least of them have not issued a deal this year. In addition, the frequency of issuance by manager has declined quite significantly. So, for example, 20 managers printed a deal in 20 managers, 88 managers printed a deal in 2023 so far in the BSL market. Out of those, 20 printed a deal, 20 who printed a deal in 23 had to wait more than a year compared to when they issued their prior transaction. Another 25 managers waited more than 6 months before they printed a deal. And just again, a couple of numbers to illustrate the frequency decline. So in 2021, 20 managers issued 5 or more transactions. In 2022, that number slightly declined to 17. In 2023, we see 1 manager having done that. 4 or more transactions. 4 is a frequent benchmark. A lot of managers say we want to issue a deal per quarter, 4 deals a year. Those numbers are 36 managers did 4 or more transactions. So this would represent basically a universe of managers of 36 who have steady issuance, right? That was in 2021. In 2022, that declined to 22 managers. In 2023, that declined to 8. So only 8 managers have done 4 or more deals, this year. So I'll stop here and see if anyone else wants to add anything to this question.
Komal, I think you were going to also add to what you're seeing on the fundamentals and technical side.
Yeah, just to kind of build a little bit on the challenging arb year for everyone, obviously in the market, that's market for CLO creation. I think what that also did was it created a positive technical. I mean, this year it's generally been, we've seen fundamentals generally deteriorate through the year. Because of the loan market fundamentals deteriorating, obviously, and a lot of the CLO portfolios looking more like static portfolios. And I mean, the real value add is the active portfolio management that the CLO managers can do. So while on a backdrop of deteriorating fundamentals, we did see spread tightening throughout the year, and I would say most of it was due to technicals. I mean, the only real time we did see spread widening was the regional bank crisis in the first quarter of this year. Since then, we've slowly seen spreads grind tighter, and then we did see a spike in supply in the market between both new issue and secondary markets. So obviously that and a little bit of volatility in the macro markets kind of as a backdrop. That caused spreads to widen just a little bit, but I would call this year we've traded more on technicals and rate volatility and volatility in other credit markets more than fundamentals, and then similar kind of themes. So obviously CLO spreads tend to move, somewhat in sympathy with at the top of the cap stack with the investment grade corporates, and for BBB and below, somewhat in line with high yield OS spreads. So those markets, especially the high yield market, again, very similar theme, very, very strong technicals, negative net issuance. So that's obviously helped keep spreads where they are. So I think that also kind of played out. Same thing with the junior CLO tranches, I would say. Very strong technicals for the loan markets is pressured because of that, the technical bid for loans and where loans are trading right now. So on a market value OC basis, obviously that's helped the spreads on some of the junior CLO tranches kind of tighten through the year. So that's kind of been the theme this year. It's been generally a year for carry, and we've seen a little bit of volatility around that sort of technical picture. But that's kind of mostly how it felt like this year.
Suman, what are we seeing in terms of demand through the cap stack? And is it very hard to find purchases at the moment? Are there notable players in the market?
Yes, very interesting question. So going into the year end, what we are seeing from our seat is there are three distinct pockets right now for AAA investors. One is obviously overseas Japan, and I will elaborate more on it, which way it's going and what is the expectation going forward. The second is US domestic, but then US domestic is sort of bifurcated into two duration cohorts. One is the standard longer duration 5-2 cohort, and another is the shorter duration 1-1 static or 2-1s. You call it whatever you want. So these are the three different cohorts in which we see the AAA demands coming in, and obviously for some of the Euro RR issuers, there could be some incremental demand coming in from some European asset managers. Now, Japan, for the large part, I would say the big investors, they are done for the year. Not because they see any headwinds, not because of the fundamentals or anything like that, but mostly because they are through with their budget on the back of heavy purchase, on the back of where dollar yen is right now, and in general because this is sort of year end. So I think they are going to recalibrate and they are going to most likely come back in the market next year. That being said, there are other 2-3 big accounts which are active, probably one or two more bullets to fire. And then you have regionals, which are always coming in and coming out of the market, much more nimble and much more reactive in terms of where the cross-currency basis is, where the dollar yen is, and all those other dynamics. So that's what Japan is for you. And mind you, this year, unlike other years, they have been holding the line on the fact that they do not want to tighten the market. So they have been a source of, I would say, steadying the AAA market, so as to speak, but not certainly tightening the market. Then I would say the syndicated path with domestic investors, especially on the longer duration, is mostly open for tier 1 managers. Tier 2 and tier 3, they are likely priced out. Not much demand for that paper. Where we are seeing right now a lot of investors, especially some of the biggest asset managers in US, they have ads is for shorter duration papers. Call it 1-1, 2-1. They are putting those, they are sourcing those papers and putting them in their ETF sleeve and whatnot. So that is something which is sort of you will see in the market of late. That is something which has sort of given rise to a lot of print and sprints, static print and sprints, 1-1, 2-1 deals, and so on and so forth. So that's the state of the AAA market, I would say, right now. Going forward, it remains to be seen what happens on the Basel III. As you guys know, it was introduced in July, if I'm correct. I think right now it's in the comment period. Probably it ends around end of November or thereabouts. The jury is still out. It's not very clear that it's going to be net negative for CLO AAA demand insofar as the domestic bank buyers are concerned. And the reason why I say that is purely because if you look into the details from an RWA perspective, not bad, right? Yes, Resi, their RWA is 20%, but if you look at high par sub AAA SPG products, they are recommending RWA of 15%. So that's a net positive. All of these, fixed income products, which are held to maturity, they are marked to market, most likely will likely flow into the capital ratio calculations. Now that again is a net positive for a floater AAA. So the jury is still out. In my mind, I think it could be a net positive. Obviously, from a bank perspective, it's always a trade-off between ROE versus what's your capital charge, right? So what that means is that, yes, there will be a demand from regional banks. Would they tighten? I don't think so, because they need to hit their ROE targets as well, more so in light of the capital charges, which are just going up, given the way the regulations are panning out. So that's on the AAA. Equity this year, what we have seen, or at least that was definitely true at the start of the year when the ARB was really, really challenging. And as Constantine said, there was a time when, the loan prices were in, people were able to construct portfolios in 96 or, low 96 or thereabouts. The PO component of the ARB was working. But barring that, for a good part of the year, what we have seen is three distinct equity investors playing in the market. One is the manager of the captive equity, and they sort of like, I would say, control the timing, they manage their own destiny, and in a way, they have been a steady source of equity capital, in the CLO market this year. The second pocket which we have seen is programmatic third party, and what we mean by that is there are certain, third party CLO equity investor who have programmatic long-term tie-up with managers. Now, why is that important? Because they do not look at one deal from a one-and-done basis. Maybe the arb is a little tight, the execution is slightly wider, the VAP is right not there, but they don't look at it from a one deal perspective. For them, it's a programmatic engagement, and out of 10, probably 8 will be super accretive. 1 or 2, they are ready to compromise. So again, they have been steady source of equity capital as well. And third, as we all know, the opportunistic third-party investors. What I have seen from my seat this year, what changed from last year, is a lot of these third-party investors last year were doing majority ticket. This year, they switched their MO. They started doing a minority ticket, and they started sort of like balancing the asset liability as closely as possible. Now, what do I mean by that? Last year, as you guys may recall, there were a lot of warehouses which got stuck. They ramped, but they couldn't get out. There was a lot of pressure going to the year end last year. There was a lot of pressure, at the start of this year as well. So all of these third-party opportunistic equity buyers, they learned their lesson from it. And what they started going forward this year is that they will lock in a deal, they will open the warehouse, but they will ramp only when you have locked into AAA. And they will sort of like move the asset, lock in tandem with the liability cap stack. So if you lock into AAA, they will let the manager ramp 64% of the total deal size. You lock in more of the mezz, and they will let the manager ramp more. So that way, A, they have execution certainty because they have locked in the AAA, and B, they are sort of trying to minimize the ramp risk. So these are the 3 pockets, these are the 3 dynamics which I have seen this year play out. Going forward, I think all these 3 pockets will be active. Definitely, this has been a year of capital raise. I mean, believe it or not, from my seat, I have seen at least 3-4 managers raising new captive equity, coming into the market, coming to us and saying that, hey, we have capital for next 4 deals, 5 deals, 6 deals. Believe me or not, last evening I was chatting with a manager who said equity capital is not even a concern for us. We don't need any equity capital. That's not even a value add. So in this environment, yeah, I think that's valuable. I think equity capital is right there. They have provided manager with enough dry powder that they can keep issuing. At the same time, these programmatic CLO equity buyers, they have always been there. They'll continue to be there. They are actually forging new partnerships. If you look at the market, and then the last cohort, which was the opportunistic CLO equity buyer, they always come in and come out. They have a fixed IRR bogey. They may come in the market or come out of the market, but I don't think they are going to be the chief driver of the issuance or the CLO new issue formation, so as to speak. Insofar as equity capital is concerned.
Okay. Well, so given we've heard about a few challenges in the market, Alina, from your perspective, what's kind of Fitch expectation, and are there any concerns about tranche performance or ratings performance?
Sure. So part of my responsibilities is to do surveillance. So we cover at Fitch, we cover something just north of 800 BSL CLOs and about 50 middle market CLOs. So just listening to the previous panels, broadly speaking, there's consensus. There is an expectation of mild recession. The expectation has been kind of pushed back. I think it's now consistent with our economists' view, first half of next year. We are seeing some deterioration. We're seeing pickup in defaults. Our leverage finance team projects something from, say, 4% to 5.5% on a notional basis of defaults not through the end of this year, through the end of next year on a notional basis. So roughly about 20% of the underlying BSL loans, again, based on a notional basis, is on outlook negative. And in addition to that, our corporate leverage finance team tracks loans of concern. So they tiered into 3 levels. Top tier, it's about 4% of the overall institutional BSL market right now. That's issuers that are kind of expected to default, likely to default in the next 2 years. Then there is tier 2, which is also distressed credits, but less likely to default in the near-term future. That's another 4%, and another 8% tier 3. So altogether, it's 16% of the institutional market that's generally you could think of as weak credit. So again, 20% on outlook negative, 16% some loans of concerns, and that's what we're seeing to some degree, in sort of more, to a bigger degree in more seasoned CLOs, to a smaller degree in newer transactions. But it's always, when people talk about deteriorating underlying performance in the portfolios, you always kind of turn around and think about how CLOs, and I know it's not very original, but CLOs are structured to withstand that kind of stress. It's not a stress of, say, great financial crisis level, and not kind of a sudden stress that we've experienced in 2020. So I think expectation is a slow grind in terms of defaults picking up. So we did recently update our stress report. So we conducted 2 stresses, applied it to our portfolio and the surveillance. So one was just kind of very indiscriminate, just let's downgrade. Not our expectation, but it's a stress scenario. Let's downgrade all issuers rated B and higher by a notch, B minus and lower by 2 notches. And with a flow of CCC minus, we passed it through our modeling. And we're seeing that AAAs are remaining just intact in terms of our modeling results. So they wouldn't be, something like 85% would not be downgraded. And those that would be downgraded would be very, well, I'll call it mild downgrade, a notch. And obviously that's based on the current portfolio. We all know there's active management in portfolios, composition will be changed. And so the picture is a little bit sort of darker for mezzanine tranches, where we're seeing something like 40, 50% of the tranches would be impacted. But again, that's kind of, in my mind, that type of a stress is a broad, wide systemic stress. And then really briefly, the second scenario was a scenario we actually looked through the portfolios. We identified which deals have these exposures to the loans of concerns I was talking about. So that was sort of more tailored, more granular analysis. So there we defaulted tier 1 and tier 2 upfront. That's in addition to our standard default assumptions. And just again, tier 1 and tier 2 is 8% of the portfolio. Then we downgraded tier 3 by 3 notches. On top of that, we downgraded anything on outlook negative by 3 notches. And then to kind of top it off, we took all of the upfront recoveries. That's about 8% of recoveries. So 8% of defaults we applied upfront. We kept recovery at 30%. That sort of reflects, what market concerns seem to be the near-term recoveries. And so in that case, AAAs, again, very solid performance, 95% remain intact. And sort of, and obviously you see more, I'd say mezzanine tranches 70 to 80% would not be impacted. And where you see that sort of being most impactful is below investment grade double B and single B tranches. So it's about 50% would have some sort of level of a downgrade.
So kind of moving on to the refi reset market, we've seen very little refi reset activity recently, and deals are also exiting the reinvestment period. So Greg, do you want to talk us through kind of how that may affect tranche paydowns?
I'll give it a go. I think the statistic that's been bandied about is that roughly 40% of outstanding deals are out of the reinvest or exiting reinvest this year. So what's happening with those, and are these AAAs actually paying down? I'm going to talk a little bit about some study that we did looking at deals, how fast they're paying down, which ones are, which ones aren't, and then things that investors can look at and maybe create opportunity for outperformance when looking at CLOs. This is probably basic for most of you, but I still run into investors on a regular basis who are involved in this product that don't know that CLOs can continue to reinvest after the reinvestment period. A lot of people just think, oh, that's when it ends. Well, then my AAAs are going to start paying down, right? Well, maybe, maybe not. Most deals have language that allows the collateral manager to do this, and I will say that it's generally the more sought-after names in the marketplace that are afforded the flexibility to keep trading after the reinvestment period in the docs. Every deal is different, so it pays to read the book. What do we look for? There's different, what I would call hoops that a manager has to jump through in order to keep reinvesting after the reinvestment period. A lot of those concentration limitations and collateral quality tests have to be maintained or improved, but in some cases it's a must-pass language. So what does that mean? If the deal has must-pass language, that means that if the wharf is failing, manager can no reinvest going forward. So going through those details and then looking at the portfolio where it stands now and understanding how that deal is going to play out over the next 12 to 18 months creates opportunity. What do I mean by that? Well, as deals pay down, they delever, AA becomes AAA, single A becomes AA. You want those opportunities. You want to look at mezz bonds, particularly at a discount, that can benefit from a deal going static. We did a little bit of work, 426 tranches across 397 deals, and we plotted the factors on the tranches. And what you notice is that right out of the chute, not that much difference deal to deal, but as the time passes after the deal exits the reinvestment period, that some deals are paying down and others aren't. And as you look further over time, the actual factor on the tranche is generally higher than what you would project using the standard assumptions that people trade CLOs to. I mean, the market runs everything one speed, right? It's 2 CDR, 20 CPR, 65 recovery, and that's not necessarily what plays out as these deals evolve. And again, as further you go past the reinvestment period, you'll notice there's tranches that are really not factoring down. We found that pay down rates, did increase the further away from the reinvestment period you go, but the pay down rates are pretty darn slow on some to start out. We took a whole bunch of deals, and then I just sorted it by factor highest to lowest and looking at the reinvestment period. Deals that exited the reinvestment period for a significant amount of time and barely paid down anything. In fact, there's a lot of deals where you're not even getting 1 penny of principal that first period following the end of the reinvestment period as the AAA investor. And that's because a skilled manager is redeploying and reinvesting in collateral because the debt coupons are advantageous. They're out of the money. There's no reason to refinance it or reset it. Just keep trading and earn extra spread on the portfolio over time. So we took a look at a particular deal and we projected flows going forward with standard assumptions. What you see there is the red line is supposed to be how fast this tranche was supposed to pay down. And the dotted line is the actual factor. And what you notice is that it was well behind pace until, as the deal got seasoned, reinvestment got thwarted, and then it caught up again. So bottom line, you would have thought you were getting a 1.7-year bond, and you end up with a 3.4-year cash flow. It doubles the average life of the front pay AAA. Here's just a demonstration of there's a lot of trading going on. There's fewer sales and purchases because a lot of that is reinvesting, prepaid loans, but there's reinvestment going on. Another quick study we did was on a single tranche that maintained a tranche balance much higher than it was supposed to be. So was it prepays or reinvestment? It's really simple to go and say, okay, well, what if we ran 5% prepayments? Well, in fact, it was even slower than 5% prepayments when you look at what the projected cash flows would be versus reality. Points here. Extension risk is more important when the AAAs are trading at a discount because you're not going to get the promised return, right? The cash flows aren't coming back. Part of your return is coming from the discount that's not paying back par. And then the other point, and I touched on this earlier, but if you are looking for opportunities to benefit from a deal exiting, reinvest, and delevering, there's ways to do it, and those can be trades that work quite well for investors. As the AAA amortizes, the rating agencies tend to give the deal credit for the trading restrictions and for the lower leverage in the transaction. That's when tranches are getting upgraded. It's deal by deal. Read the language, look at the portfolio, and try and understand what prepays might be like on your particular deal. I'm going to touch on how I look at a portfolio as it exits reinvest. Generally, the shorter the weighted average life of that portfolio and the better the credits, the higher the dollar prices of the loans, you're going to see faster prepayments. So I look for deals with high quality portfolios, exiting reinvest with limited extension risk. And again, those short maturity portfolios, they might not pay at 20, they might pay at 40, 50, because that's not the market, that's this pool. And it's this pool with the short average life. Remember, the manager can reinvest, same or shorter maturity, same or better rating in most cases. Well, at some point they run into a wall, they can't keep doing it. And that's when the deals hammer down. And we've seen, just like that venture bond that I went through at the beginning, paying down slow, and then boom. Deals, managers realize that they can't keep the game going and they just unwind.
Right. And given that so many deals kind of are exiting the reinvestment period at the moment, Suman, do you expect an uptick in refi reset activity, or is it just, it's not possible given where spreads are right now?
No, I definitely expect uptick in refi reset activity, but that's not just driven because deals are exiting the RP. One thing to keep in mind is what happened in 2022, right? A lot of deals got printed 5.2, 3.1s, whatnot. High spread. A lot of these 5.2s are going to come out of their non-call next year. So rest assured, the volume of reset next year is going to be pretty high. In fact, if I do a back of the envelope calculation, 2022 was what, 100 to 110 billion issuance. I would say 60-70% was 5.2. So 5.2 versus 3.1. Those 5.2s are probably coming out of their non-call next year. Out of that, 80-90% will get in the market for refi reset. So I think just by that calculation, again, please don't hold me to that. It's not Morgan Stanley House View. They haven't even published it. I was trying to read the research to come up with a number, but I couldn't. But I think in my mind, it could be close to 50 billion or so. So there's going to be a tremendous supply of reset paper just purely because of that. And that's something which we saw this year as well, because you may ask, hey, what happened to those 3.1s? Yes, actually, they did come back to the market. They were, I would say, they came back to the market not because the reset was too much in the money. That was not the case, barring a small window. It was purely because they had a good opportunity to do a par flush. Now, there were three, I would say, components of par flush. And in general, in research, there are three components of par flush. One is the natural par build, which the manager will do from trading activity. Second is, if at all is possible, can you lever up the deal? And guess what? If you look at bulk of the 2022 deal, they were 9.5%, 10% double B attached, right? This year, I think 9% was sort of like the base rate. Nowadays, you can even do 8.5. So you can actually lever up the deal. And third is, it comes at a cost. Can you do an X note for the bill for the reset and some more? Probably yes, you can do that. So these are the, I would say, three main components of the par flush. And all these three components were at play this year. So it was a very good year for some of those 3.1 2022 vintage deals to get reset, and the equity took advantage of it. And I think going forward, it's going to be even more voluminous year for reset purely because a lot of these 5.2s are going to be in the market.
And, sorry, go on, Constantine.
Just a very quick point to add here in terms of resetting transactions that are exiting the reinvestment period, right? So to reset a deal, you have to overcome first the realized losses. This is basically any trading losses that are irreversibly realized by the manager. Unrealized losses, these are basically the par haircuts that the rating agencies you need to make up those in order to establish the new par subs for the reset. And then in addition to that, the older vintage deals are more levered than the newer ones. So for example, if you have a transaction that has a 6% single B, 6% par subordination, single B, 8% double B, you would probably need to get now to a more typical subordination of 8.5, 9% double B. That means the equity has to inject basically 3 points just to bring the structure back to what the leverage is today. In addition to that, you also may need to, the management may need to clean up the triple C bucket, which also comes at a cost. So given all these factors, it's not a very large universe of deals, I believe, in those that are exiting their investment period that are resettable. So we're going to continue to see these pay downs as slow as they may be, which, by the way, on the margin does provide new capacity for AAA demand, which should help new issuance to some marginal degree.
Great. And Komal, how are you viewing it from the investor perspective when you're seeing deals that are exiting their reinvestment period?
Yeah, so deals that are out of the reinvestment period, one, obviously, just like Greg presented in his slides, it just depends on how far out it is, and it also depends on where in the cap stack you're invested. So if you're invested in the AAA, AA part of the cap stack, of course, we're more focused on if the deal is passing or failing the wall test, how fast it can delever, because obviously you want that discount to amortize faster than obviously SOR. So at the top of the cap stack, deleveraging really the pace over the last year, it's really at that 18 to 24 month mark where it really starts to pay down faster. But regardless of the pace, obviously some managers obviously are able to keep cash reinvested in the deal for much longer, and obviously those deals that are amortizing triple is technically obviously trading a little bit wider than where they should. But regardless, it's all good at the AAA, AA level. And even if the deal gets more and more distressed, it's all good at the AAA, AA level. If you're failing OC tests, which a lot of the earlier vintage, 2012, 13, 14, originally 2012, 13, 14, 15 vintage are failing the junior most OC tests. So that's also helping the AAA, AA because the speed of prepayment obviously is faster. The managers are able to do less in terms of the reinvestment. And the cash that would have otherwise obviously flowed out to equity goes to deleveraging the structure. So those deals specifically, the hairier profiles failing junior OC tests, they don't have a path to getting called at this point because the debt is not covered, but at AAA, AA level, it's very attractive. But if you go further down, the mezz tranches, especially the double B tranches, I mean, this is really the first time in 2.0 world with these structures that we've seen deals outstanding for so long out of their reinvestment period. And that balancing act where managers are actually just trying to, extend deals and reinvest proceeds, it has to be also offset by a reduction in actual portfolio risk. So we've seen in a lot of cases, because the most, obviously OC tests are very important, and a lot of times, you can, to keep the cash on cash going, the managers are more focused to, keep that kind of cash stream open and less focused on sometimes reducing actual portfolio risk. So if that tail risk kind of keeps growing as you try to, not focus on it as much, at some point, even that deleveraging that's happening in the structure, even after you fail finally the OC test and the cash on equities dries up, that deleveraging still is not enough to help, bring those double Bs and in some cases single Bs to the finish line. So those are a lot more messier situations, and there's quite a few of those out there in the market right now. And it's going to be an increasing share if we don't see the 2018 vintage, which comes out of reinvestment like all of this year, and by the end of the year reset or extend somehow. So those deals, it really comes down to the ability to actually analyze that tail risk. You have to have a very good view on recoveries there on a line-by-line basis, because obviously we've seen that in the loan market. CLOs are the 70+% buyer of the loan market right now and determining a lot of the valuations in the loan market. So any paper that's not suitable for CLO kind of drops 10 points, on the next weaker earnings report. So that tail risk that the double B tranches or single Bs are exposed to for post-reinvestment deals, it's very, very profile dependent, and you have to be comfortable, one, analyzing that risk and taking that risk to be invested there. But again, at the top of the cap stack, I think deleveraging AAA profiles still provide pretty good value right now.
Right, and Alina, I just want to quickly get your views from a ratings perspective on that, and whether you are seeing delevering and the
Yeah, that was exactly that spot on, right? Because I think, Greg, you were talking about how generally people expect that as the deal delevers, the rating agencies start upgrading. That I would say it's true for the top of the capital stack, but sort of somewhere around single A, triple B, depending on the environment. That's where you kind of it's deleveraging versus the tail risk, right? On the point about deals being able to reinvest, we also did our own research and published a report. We were kind of trying to look under the hood how exactly which documentation provisions CLO managers are able to use to be able to participate in maturity amendments and so on and invest. There is a big difference between sort of the slowest amortizing deals where they were able to purchase 41% of the original target part 2 years up post reinvestment versus slower. There's a big discrepancy. There are a lot of factors going into that, from the docs to the manager style to the investor base. But one thing I would say that, the bright side is that we've seen that across the sample of deals that we are seeing sort of being able to more freely reinvest post-reinvestment, they are able to preserve par better and kind of maintain the credit quality. And I think that sort of makes sense because you have a bigger set of, you're not pressed to buy short-dated assets that arguably had a hard time finding refinancing solutions, right? So you have a bigger set. So we're seeing these deals being cleaner, and that's going to play into, rating actions, tail risk versus the leveraging.
Okay. We're getting close to out of time, so could we get the polling question results up? And maybe I'll open it up to everybody on their views of the results. So it looks like, oh, okay. No bad managers, only bad prices, 50%. Komal, Konstantin, any thoughts on, do you agree? Is that what you expected?
On the results?
Yeah.
Yeah, look, no, I mean, look, the market has matured quite a bit over the last few years, and investors who are stuck in a narrow sort of view of what they can buy are decreasing in my view. I think there are more and more investors who can assess the risk-return trade-off. That's why I'm not surprised, actually, that no bad managers, only bad prices, because I think investors are well-educated and have had a lot of experience to be able to evaluate opportunities on a trade-off basis, risk-return, as opposed to just stick to high quality at any price, right. For example, right? So I think this makes sense. Of course, there's a variety of investors, how they approach the matter. Some of them have very tight manager lists. Even in Japan, for example, right now, we've gotten to a stage, the market has matured, and most of the investors have a broad enough manager list with enough, cadence, frequency of issuance, that they're not looking necessarily to expand their lists at the moment. But anyway, that's my take on this.
Okay. Well, we're out of time, so please join me in thanking our panel for a great discussion.